Hi, everybody. Thanks for joining and listening to me. As you know, we're raising up to 5% equity, which is about 20,000 shares in Advisor Ratings through a rights issue. And we're now opening that up to the public. Now, over the last 48 hours, I've carried off a lot of Q&A with potential investors, and there's 5 key areas that actually keep coming up. So I thought I'd use this opportunity to cover those off in this one sort of audio video hit. If you don't mind, I'll end up sharing my screen so it's easier to follow. As you know, we're raising through Birchal. You can go through to birchal.com/company/advisor ratings to access the offer document. And if you've already done that, please continue to read through. But the Q&A that I keep receiving can be summarised really into 5 key areas. One is, how did we arrive at the valuation of $9.8 million? What does our near-term forecast look like? Obviously, some of this is governed by the crowdfunding legislation rules around how much we can and cannot say, but I can share some at least immediate sort of outlooks here. The quality of the revenue that we do currently have on our books, and what does that look like today? Also, the market opportunity, both here in Australia, but also overseas, and what's our exit strategy and timing. So if we go through to valuation, this business now is 5 years old. We have spent about $7 million on the product to date. Now, $5 million of that is raised through high net worth capital. I'm one of the major shareholders, so I've spent my initial, obviously, equity that I put in from day one, and then we've raised a bunch of raises along the way. So some bridging and some Series A rounds. We've also invested further $2 million from the R&D tax incentive. So we've now got a really robust platform around security, scalability, and the fact that we're now the first mover in this market of financial advisors. To date, we've got close to 30–40% of the captured market of advisors in Australia on the platform that are engaged on a regular basis. That's increasing every day, especially as the market moves to, I guess, a far more scattered approach. There's more practices, more licensees appearing each day. Our recurring revenue of $1.2 million. So that's now banked revenue that we, in terms of contracted revenue that we expect to have each year. We've had a couple of successful wins over the last 2 or 3 weeks, which I can mention over page. 22 tier 1 contracted clients. As you'll read through the offer document, they include people like AustralianSuper, Zurich, Magellan, some really good tier 1 fund manager and sort of super funds, Q Super, for example. Now, our actual model itself is a licensing subscription model. So that in itself lends itself to a good valuation in terms of long-term recurring revenue within the business. I guess one of the questions that always gets asked is there any market comparison? Obviously, as the only player in this space, we are at an advantage. But if you look at like clients or like businesses, I look at Rate My Agent, which in 2016 raised $5 million on a $20 million post-money valuation. It had a recurring revenue at the time of $1 million. In the last few years, it has managed to capture a slice of the Californian market. So it used that $5 million to go overseas and is now listed under the ASX code of RMY on the stock exchange. It's valued today at $105 million. So I guess as our nearest peer in this space, you could use RMY or Rate My Agent as a close sort of like-for-like business. Now, we are raising capital at a 20% discount. Why the 20% discount? Well, it really reflects the ASX decrease from the last time we raised money last June to today in May. So I think that really just reflects the current market conditions. But that said, we've seen increased leads come through our platform, increased traffic over the last 2 months due to the market downturn and the market variance and fluctuation on it. And actually, we're seeing increased activity out there from people in terms of wanting access to our data. So we have quite an optimistic outlook, and I think we believe it's quite counter-cyclical in terms of an increasing market for a product like Advisor Ratings. So that's the valuation of $9.9 million pre-money. The second one is, what does our near-term forecast look like? Again, under crowdsource legislation, we can't go too far into the future, but what I can say is we've had some recent successes in the last 2 weeks. Now, what I mean by that is we've had a contract win and 3 other draft contracts from major clients that are currently in the process of being signed. I'm not at liberty to announce the names of those contracts just as yet because they are unsigned. That said, that should have a significant uplift for our near-term revenue. We are forecasting a forecast of $558,000 for the quarter. We do expect a good close out to June year end, going into 2021, where the pipeline continues to grow and continues to be strong. One of our near-term opportunities is actually not only converting the current pipeline, but also upselling and converting new product to existing clients that's coming online in Q3 of this calendar year, and that's the vendor marketplace if you've been through the crowdsource funding document. Now, the quality of our revenue, again, aforementioned before with the previous slide around valuation, we're at a 1.1 million annual recurring rate. That's now actually 1.2 to 1.3 based on the recent sales, and you can see the right hand graph here about how our revenues are increasing accordingly with the new clients that we've been winning. Now, we've had a 100% success rate in terms of renewals. The challenge we always have is whether we put clients on a 1-year contract or roll it up into a 3 to 4 year contract. Now, we try to balance both in terms of locking in future revenues, but also not sort of decreasing the value as we look to the future. We think that there will be increased value in those contracts as more data becomes available. So for us, it's about adoption and market share penetration and servicing the client with the opportunity to look at price down the track. We do have some one-off revenues, and you can see that down in terms of the bottom left-hand corner here. That obviously is dissipating as we start to increase our recurring revenue bucket. Now, one-off revenue includes items such as research, one-off research that we conduct, our landscape report that I know many clients have bought this year, and also in terms of advertising and the like. Annual contract revenue remains steady at about $46,000. As I said, that really at the moment has the opportunity to only go up at this stage, we believe, based on the fact that we have quite a unique service and proposition. That said, we're always looking around the corner to make sure where our competition does lie, and if any competition does enter this market. The general market opportunity in financial planning is actually quite significant. So you have some very, very big balance sheets playing in this space: super funds, fund managers, life insurers, technology providers, all of which make up a portion of our current client segment. But you have a look at the fact that we've got 22 tier 1 clients at the moment. There's about 1,000 that have the type of money that we would say or the type of business that we would say that need our product in Australia. So the opportunity in financial planning alone is quite significant. There's obviously other product opportunities that we're currently working through at the moment to increase both client and contracted revenue. And as I mentioned earlier, the vendor marketplace is one of those. But there's a multitude of products once we sit on this data lake that we have that we can start to build out. That said, the other areas that we are looking at are professional service occupations, where our product now is scalable. We're particularly focused on mortgage brokers as a near-term profession, with the Royal Commission outlining the fact that those brokers will end up having to become financial advisors, and under the same regime, that presents a really strong opportunity for us, and there's 18,000 of them in Australia. Solicitors and accountants also being professions that I would say consumers look to very much in the same vein as financial advisors in terms of wrapping up all their finances into one bucket under these four professions. So there is some significant opportunity in Australia here just alone without even looking overseas. Our short-term forecast, though, is looking at financial advisors and making sure that we nail down that space and play in that space well, and continue to grow the trust in that segment. I do want to raise the US and the UK, especially as opportunities for advisor ratings. Now, the SEC, the Securities Exchange Commission, and the Financial Industry Regulatory Authority in the US, quite a different model to Australia. ASIC governs all of financial advisors in Australia. The FINRA is an independent body that sits under the SEC. I guess if you could say anything, it's very much like what will be the code monitoring body in Australia, but it looks after the investment advisors in the US, and then the SEC looks after the dealer brokers. That said, the SEC does govern all the 500,000 financial advisors, let's call them, in the US. Legislation changes that have recently been flagged that look like they're going to be adopted is around testimonials. So us being at our core a financial review site, unfortunately in the US over the last 30 years, the testimonials has not been allowed on financial planning sites. Well, obviously, with the internet only being around the last 10, 15 years, that's not actually the case or able to. But that said, that legislation is changing. So we're really, really well placed in that segment. Now, I'm not at really liberty to give away too much on this Q&A session around what our market entry will be, other than we have had chats with the SEC and FINRA, and in terms of what that market opportunity and that market entry strategy looks like, we have actually already put down some initial plans in place. Data's accessible in the market, very much like the Financial Advice Register here and the open accessibility to data. They do have that in the US. In the US, they capture areas of interest around, whether an advisor's, for example, failed or passed their certain exams. They do have a far deeper register around complaints and narrowing it down to the individual advisor as opposed to the practice. So from that perspective, the opportunity around data is a lot greater. The UK, again, we've already done a reconnaissance mission through Mark Hoven, our CEO over there, about 12 months ago, and the Financial Conduct Authority is very, very interested in our business model. They have recently launched at the start of this year their own register. They're called the FCA register, very much like our Financial Advice Register. So again, data accessibility in the UK makes our business far more attractive in that market than it would, say, other markets where data is less available. So that's the market opportunity in those markets. The timing obviously will be very dependent on when legislation passes in the US, and also in terms of us ensuring that we have safely secured the financial advice segment. Now, our exit strategy and timing, obviously there are different areas where advisors have the ability to liquidate or have a liquidity event in this business. Obviously, IPO and trade sale are the two obvious areas. With that said, there's always key risks in going down either of those paths or having that short-sighted approach to an exit event. And personally, I'd like to see this through. In saying that, there have been some investors that have been in this business for quite some time. In the next 2 to 3 years, we'll be coming up to sort of 10 years in the financial planning space. So we do want to give the opportunity for investors to have a liquidity event at some point. In saying that, all our key staff have been tied in recently to ensure that we've got continuity of service and that we can deliver on all the products that we say we will. So they're the key Q&A areas that we've covered off. If you've got any further questions, please drop me a note. If you've got any, again, drop me a DM on LinkedIn or through my email address, which is angus@advisorratings.com.au. Thanks for taking the time to listen.